to you. We're shifting. We've had an amazing discussion of upstream, and I'm now turning to the market for natural gas, which from the African perspective is going to be primarily LNG. I'm going to talk a little bit about the trends in the LNG market and then what it means for Africa. I think we're back on schedule, but I got a short time, so I'm going to gallop through these slides and maybe leave you with questions which we can handle later. I'm also chairing a fantastic panel a little bit later on this stage to discuss LNG with an absolute great panel, so I hope you come back or stay for that. The pendulum of the cyclical LNG market is now swinging back. We've been in a very tight market with extraordinarily high prices in 22 and 23, still high prices the last couple of years because of the cutoff of Russian gas into Europe. But now the cavalry is coming. There's a surge in liquefaction capacity coming from everywhere, first and foremost from the US, but from a lot of other places too. And this supply surge we see now extending to the end of the decade and into the next decade with the FIDs we're seeing now in the United States and elsewhere. Can global LNG demand keep up with this supply surge? The short answer is no, not in the near term. But the more complicated answer, which is one we're spending a lot of time and effort looking at, is as prices come down for spot LNG, what does that do to demand? How price sensitive is global LNG demand? And the answer is, to some extent it is. Low prices and high prices always solve themselves eventually by triggering market forces. So this coming abundance we're seeing in the global gas market brings, I think, short-term challenges for African LNG exporters or would-be LNG exporters, but also some opportunities, which I'll get into. This shows the build-out of liquefaction capacity. Won't go into detail here, but we're taking global liquefaction capacity, which was at 460 million tons at the beginning of this year, to very close to 600 by the end of 2027. That's a surge in supply. As you can see here, a lot of it is from the US, a lot of it is from Qatar, but it's pretty broad. There's a bunch of smaller projects around the world, and as you can see, the non-US, non-Qatar additions, about a quarter of that is coming from these projects in Africa. LNG is just a classic cyclical commodity business. Prices are high, everybody builds, and then all that supply comes on the market, and then prices go down, and people stop building, and again, and again, and again. And of course, in the LNG business, to go from FID on a liquefaction plant to first export is typically 4 or 5 years for most technologies. And then if you add in integration with the upstream, it's even longer. So that's a very, very long lead time. This cycle has been more intense, and that's because of the Russian gas cutoff. That's something that doesn't normally happen. 150 billion cubic meters per year of supply just cut for political reasons over the course of a few months in 2022. So that drove prices very high and created this intense high price cycle that's helping bring this new supply on. So we're in the supply catching up phase. I talked about that already. And then is supply going to overshoot? We have been doing our US outlook for liquefaction FIDs this year. We stopped using pen. We started using a pencil with an eraser because they just keep coming. And we already have 53 million tons of capacity taking FID in the US this year. And there's probably more to come before the end of the year in early 2026. It's quite extraordinary. Of course, there's a reason for this. The Biden administration stopped granting export authorizations for LNG projects. The Trump administration has come in and provided those authorizations, so there was sort of pent-up demand to move forward with these projects. Qatar is coming. A lot of other places are coming as well, including Mozambique, which has been a big theme in my discussions this week here. The fact that there's going to be a lot of supply and prices are going to be soft, it's not a big secret. And if you listen to some of the leaders in the industry talk about it, they acknowledge this, but they say, look, we're in this for the long term. We understand prices go up and down. And in any case, if you have an oil-linked contract as opposed to selling on a spot-linked contract, then you're protected from the fluctuations in JKM, which is the Asian LNG spot price benchmark. You still have momentum because you've got a lot of players that are willing to commit to projects or to offtake because they want long-term, secure LNG supply. This could be an offtaker in Europe or Asia. It can be an international oil and gas company that wants to build up its LNG portfolio. It can be a trader that is already trading LNG but wants more of a physical basis for their activity in the LNG sector. So this is still happening. I'm not going to get into detail on our demand outlook, but you can see it's quite steep. I mean, demand in LNG is essentially supply driven, but you can see a steep growth there up into the 2030s. The big thing we've done recently is started to incorporate what's the impact of lower prices on demand, and then in Europe, we had a quite grim gas demand outlook, which has changed a lot as Europe, which is still doing an energy transition, but the more exotic parts of it, electrification of heating, electrolyzed hydrogen, get pushed very much to the back burner. So there's going to be a lot more gas burned in Europe. China, I think we've gotten accustomed in a lot of commodity markets to think of China as the driver of growth. And China, of course, has been a big driver of LNG demand growth for the last 5-10 years, although it's down this year. In fact, low Chinese LNG demand driven by slow economy, a lot of pipeline supply, domestic supply to China, has actually helped us, if you're talking from a buyer perspective, it helped avoid much higher prices this year than we would have had. But what's interesting about China is it is not the long-term driver of growth in LNG demand. There's two reasons for this. Gas demand in total in China is plateauing in the 2030s because of the remarkable build-out of renewables there. And other factors as well. And then secondly, you've heard about perhaps this Power of Siberia 2 pipeline, 7,000 kilometers from Russia's core gas production area through Mongolia to China. That deal is not done, but we expect it to get done. That's a lot of gas. That's about 50 billion cubic meters per year. So we see kind of a plateau in China, but fear not. We've got India, strong growth. A lot of it is for industrial demand. This is not a power-driven picture for India. It's industry, a lot of it fertilizer, chemicals, and they don't have the domestic resource, as far as we know right now, to meet that. So we see very strong growth. I'm not going to show Bangladesh and Pakistan, but they're similar to this picture. And then there's Southeast Asia, which is the other sort of core area of growth, where gas is the fuel of choice in the power sector, and where you also have traditional producers, Malaysia, Indonesia, Thailand, in varying ways at different times starting to go into decline and needing to backfill that supply with imported LNG. So you put it all together, it's really, really strong growth. And I think one thing that's going to underpin that growth, I already mentioned just the pure lower price impact on demand, but I think also it's going to help restore the reputation of gas as an affordable fuel. I mean, people really like gas. It's a transition fuel. There's a lot less carbon emissions coming out of it. It's much better than coal for power generation and other uses from a climate perspective. And it also used to have a reputation as kind of an affordable fuel. That has been damaged by the last few years. And I think low prices is going to bring that back, make people realize that gas is an affordable fuel, and have governments, businesses, incorporating gas more seriously into their long-term energy planning. Now, those are low prices. This is our current price forecast, and those are pretty low JKM prices and TTF European prices during this trough. At the bottom of it is in 2030. And the way the market balances the LNG market, there's a number of ways, but the big way is that you get into summer, demand is low, and if that Henry Hub price, this is annual average, so don't take this very seriously, but if in the month you're in or 2 months hence, the Henry Hub price is too close to those export spot prices, those with the rights to lift cargoes from the US cancel those liftings. That's how the market balances in extremis. That's what happened during COVID, and that's something we expect for a few years before and after 2030. Final slide, what about Africa? Africa has the gas resource, not a question, all of you know it. The current momentum for FIDs is not going to last forever, but for now, as I said, you have a lot of players still willing to step up for strategic reasons, for energy security reasons. They want long-term LNG supply. They're willing to make commitments to back that. FLNG, we'll talk about it on my panel that I'm chairing later. Critical for Africa as it's a partial solution to the above-ground risk. Key point that I'll end on. The US is becoming the dominant supplier, but it's not a low-cost supplier. The price of gas for US projects is basically Henry Hub, and Henry Hub long-term outlook $4 in real terms, $4.50, something like that. If you're in Africa, you're trying to do an LNG project, and you say, oh, cost at the wellhead is $4.50, the discussion's over. African projects can compete and will compete if all the pieces can be put together. Thank you very much.